So, welcome today to Investing 101 Wealth Building Basics, part of the Get Savvy Grow Your Green Stuff webinar series. My name is Andrew Pellegrini, and I run the Student Money Management Center for the entire University of Illinois system. Today I'm in Urbana, but I sometimes travel to Chicago and Springfield since I support all of those campuses. And I am very blessed today. We are all blessed today to be joined by the U.S. Securities and Exchange Commission, my colleagues Erin and Ann. Erin, would you like to introduce yourself to our attendees?
Yes, thank you so much. I'm so excited to be here with all of you today. My name is Erin Scheithe. I am a financial educator, have been for about 20 years, and I work for the U.S. Securities and Exchange Commission's Office of Investor Education and Assistance. So, in this role, I provide investor education resources, including presentations like the one we have today, and speak to groups of all ages and all levels of investing. So I'm very excited to be here for this Investing 101 session.
And Ann, would you like to introduce yourself to our attendees?
Hello, my name is Ann McKinley. I am an acting associate director in the Division of Enforcement in the Securities and Exchange Commission's Chicago Regional Office. In that role, I supervise the investigation and litigation of securities claims, including fraud claims, insider trading, you name it. On the side, I also co-chair our military outreach group and get to do outreach presentations with Erin and Andrea. So we are required to give a disclaimer before we speak to audiences. Erin and I are appearing in our official capacities for the SEC. But our remarks today do not reflect the remarks of any of the SEC's commissioners, the commission itself, or anyone else on the SEC staff. What we are doing today is really providing just information for you about general principles of sound investing, and a little sprinkling of how to avoid fraud. We'll talk more about that next time. But we also specifically are not providing any particular legal advice or investment advice today. We do want to provide you with information that you need so you can assess your next steps to investing, but to discuss specifics about any particular investments, we do recommend that you talk to a financial professional before taking action on anything. We can't give you specific investment advice.
Thank you so much, Ann. And you'll hear me parrot similar sentiment whenever we do education about investing. It's best to speak with a financial professional, an investment professional about your individual situation, because this is very generalized information just to help you be more informed when you make any type of financial choice. We often launch a poll at the beginning of our webinars, so I will find that poll. But this gives us information about who's joining us today, which can look a little bit different than when you registered, right? Not everybody that registers that shows up. This helps inform how we talk about the different examples that we go through, how it's relevant to your situation, and it also helps us plan for future financial education efforts to cater more material to a broader audience, or be more inclusive in some of the examples that we discuss. So there's some information about age, kind of your employment status, whether you're a student or a full-time employee, which university you're affiliated with. So the Get Savvy Grow Your Green Stuff webinar series is coordinated with all of the universities within the University of Illinois system, but we partner with different institutions, departments to promote this series. So that gives us information about what marketing is helpful, and it helps some of our partners in their end of term kind of outreach reporting. So just to give you an idea of who's joining us today, we have people from across the age ranges from 18 to over 75, which is excellent. We have a lot of full-time employees and several students as well. We have quite a few folks from UIC, which is great. Usually we have more Champaign folks, but today UIC is repping it. And we also have a lot of women on, which is very great. We also have a lot of men, but good distribution of all kinds of demographics. So we have a pretty diverse group here. So thank you for responding to that. I ended the poll. And so we are going to move on to our learning objectives. So today we're really just going to focus on before you get started and what to consider when you are getting started with investing. So we want to walk through how to create a financial plan to start investing. We're going to define some common investing terms and concepts that you're going to run across when it comes to investing. We're also going to help you kind of identify how to select an investment professional. We're not just saying talk to an investment professional. We're going to talk to you about how to select one as well. We're also going to illustrate a few types of investing tools that are out there. And then we're going to summarize ways to continue learning about investing because we don't expect you to be an expert just after today's 1-hour webinar. That's impossible. So the first thing you want to do before you start with investing is to create a financial plan. And there's several ways to go about doing that. One of the things that I need to clarify here is that people tend to use the words saving and investing kind of interchangeably. But ultimately, when you're talking about the difference between saving and investing, the financial products and services that cater to either savings and investing differ on how risky they are and how much potential for returns that they have associated with them. So some examples of savings-focused products include things like savings accounts, money market accounts, and certificates of deposit. You might hear this referred to as CDs. These are typically at banks and credit unions. These are financial products that have almost no risk of losing money, but the returns also tend to be very low. However, they are usually insured from loss if you have savings accounts that are at FDIC or NCUA insured financial institutions. On the other hand, examples of investment products include things like stocks, bonds, mutual funds, ETFs, or exchange traded funds, crypto assets, real estate, etc. The risk of losing money with investing can range from very low to very high with these types of investing products. However, the possible returns are also higher with investing products than with savings-focused products. So the value with investing can be pretty volatile, and they are obviously not insured because of that. So when we talk about like why is it important to save? Why is it important to invest? Why isn't saving enough? You can't just put all your money into a savings account or stick it under the mattress because the money that you have today won't have the same purchasing power for what you may need later on. The prices for goods and services tend to go up over time. This is called inflation. We've even done a webinar specifically on inflation if you want to learn more about how that works. But for example, you could have gotten the original iPhone around $600 over 15 years ago, but today's top model of the iPhone will cost you almost double that, and that's because of inflation. Investing is the best way to try to cope with the impacts of inflation on our purchasing power. So we also often talk about how your values kind of dictate what you perceive as needs and wants. If you've heard me talk in particular, it can be kind of situational too, but to transition from more of a survival mindset to a wealth mindset, you'll also need to frame trade-offs to accomplish your wealth building goals. For example, you need hydration, but a venti pumpkin spice latte may be a want. Food is obviously a need, but a DoorDash delivery for Chinese may be more of a want. Shelter is definitely a need, but a luxury apartment with no roommates is a choice. So if you've heard me speak about needs versus wants before, I am a very big proponent of values-based financial decision making. So if one of these examples is a priority for you, that is fine. Just recognize that there are trade-offs of how that choice will impact your investing journey or your wealth building journey. So just think about that or keep that in mind. So in shifting our mindset, it's also important that we leave room for saving and investing. So for example, instead of getting a $50,000 sports car that costs up to $1,000 a month to maintain, you may opt for a $25,000 car with a much lower monthly maintenance cost that leaves a little bit of room for contributing to an emergency savings fund, your retirement, and maybe even some spending money. So it's important to keep in mind that you don't want lifestyle creep to impact your ability to build wealth over time. So investing is obviously a big part of many people's financial plan. Probably most of you that are on this call are thinking about investing as part of your overall financial plan. But when it comes to the steps that it takes to get there, beyond kind of setting your financial goals, part of creating that financial plan requires awareness about your situation, like including debt and assets, establishing your emergency savings, paying down high interest debt, researching investment options for your goals, and then determining kind of your risk tolerance and your limits for investing. You definitely want to have these steps completed before investing or purchasing, for example, a home, just because there's a financial footing that you want to have solid before you get into something that can be a little riskier, like investing. All right, so a big piece of steps towards being good for investing is to pay down high interest debt. What's considered high interest debt can vary from person to person or even among professionals, but today, as of February 11th, 2026, the average 30-year mortgage rate is around 6.12%. So if the interest that you're paying on a debt is above 7%, you'll probably want to prioritize paying that down before getting into investing. So that high interest debt will change over time based on what is considered the 30-year mortgage rate. That's the rule of thumb. Not everyone uses that, but it's a good rule of thumb to use if you're not sure what high interest debt means. So to get a handle on high interest debt, you want to pay more than the minimum. You might use the debt avalanche or the debt snowball method to expedite debt payoff if you have a little bit extra that you can put towards the payments that you are making. So you'll pay the least amount of interest using the debt avalanche method since you're prioritizing paying more than the minimum on your highest interest debt. But some people maintain motivation better with the debt snowball method since you pay off the lowest balance debts first. So you see a shorter list of debts instead of prioritizing that high interest first. If you have federal student loans, you may consider a direct consolidation loan to simplify your payments, but that's not the best option for everyone. So you want to do your research or join us for our webinar in April on student loan management. We're also posting a new episode on consolidation and repayment of federal loans on our Making Sense of Money podcast with IDFPR later this month. So we'll include some information on that in the follow-up email on how to subscribe to our Making Sense of Money podcast. And then Utah State University Extension created a debt repayment tool to help kind of people make debt payoff plans, which may be beneficial for your situation. And that is called powerpay.org, and it is free to use. So I think a really important consideration for setting an emergency savings goal is that small amounts truly do add up. I do want to go through an example because sometimes even setting the goal can be a little bit challenging for people. So let's say that our potential goal for setting up this emergency savings is 3 to 9 months of essential expenses. That's typically the range that financial professionals or planners tend to provide. But if this seems really challenging for you, just start saving up to $400 if you don't have that, since many Americans wouldn't be able to cover a $400 expense without borrowing or selling something that they own. So you want to remember to start small with what you can. You want to save securely in like an NCUA or FDIC insured savings account, and then keep going after you reach that $400 mark. Get up to 3 months worth of essential expenses. And then you might also want to take advantage of one-time opportunities like tax refunds or gift money to help beef up your emergency fund so that you are less stressed financially if something pops up that you weren't quite planning on. All right, another thing to think about is time frame matching. So how long do you have to invest to reach your goal? It'll determine what types of products might be best for you to invest in. So for long-term goals, inflation is your greatest risk. So investing and taking advantage of compound interest can really help you reach those goals. For short-term goals, those that maybe you're hoping to achieve within the next 5 years, volatility is likely going to be your greatest risk. So you want to choose investments or saving products whose values won't fluctuate a whole lot. The thing about time is that the earlier you start investing, the more time can help you take advantage of compound interest and exponential gains. And it can also help you recover from potential volatility in the market. So even if you only have a little bit to start off, starting early is really, really valuable, as you can see from kind of our chart here. So someone that started contributions when they were younger, when they were 22, and only saved $2,000 a year for 9 years and then didn't contribute anything else, they saved a total of $18,000 themselves. But with compound interest, the amount that was available at age 65 was almost $580,000, whereas our other person waited until they were 31 to start. They also contributed $2,000 annually, but they did that for 35 years, and they saved a total of $70,000, and they only were able to make it to $470,000 by the time that they retired at 65. So that's a lot of effort later rather than just starting early. So that is one component of time frame matching and starting early. The other part is, let's say you decided that you want to save $1 million by the time that you're 65. So leveraging compound interest and those exponential gains that I talked about, they can maybe provide a return of an average of, let's say, 7%. You could save as little as $254 a month if you start at age 18 and reach that goal. Or if you start later, you may need to save as much as over $6,000 a month if you start at 55 to reach your goal by age 65. And now I'm going to hand it over to Erin to talk about investing terms and concepts.
Thank you so much, Andrea. So as we move forward to this next piece, we're going to talk about risk and reward and kind of how the two correlate. So you may be wondering, how do investments work? And so how an investment is different from saving is that, of course, saving is setting some money aside. You will earn some interest in that when you keep that in a bank or credit union account. But investing, you're putting your money at risk in the stock market in order to get a bit more of a reward from that. So your money is earning money, as it says here on the screen. You are helping public companies when you own stock, and we'll get into what that means later, but you are helping companies to grow and reinvest in themselves. So you can earn interest from a savings account like your emergency savings account that you have at a bank or a credit union, or you can earn interest in other ways. Dividends are when a company is going to actually give you a little piece of their earnings on a somewhat regular basis, and you can reinvest that money. Another way is to buy something that may increase in value. So when you sell it, you hope to make a profit. So an example of this is I buy stock in a little company, where they're making electric cars 15 years ago, and the hope that that company will take off and that maybe I can at some point sell that stock at a much higher rate. Or I personally buy a home, and I hope that that home will increase in value over time. I do want to make one distinction here about stock market versus stock exchange. Sometimes they're used kind of synonymously, and the stock market is kind of a general term that we use when we're talking about investing. You are investing in the stock market, in the securities market, in investments and securities. And then a stock exchange is one of those places, a collection of individuals. A stock exchange is one part of that stock market, is one part of that stock exchange. So a stock exchange is going to be something like NASDAQ, the New York Stock Exchange. Of course, in other countries, they have their own securities markets. When you watch the news, it's kind of that bell ringing. It's the moment where a lot of people are out on the floor. That is the stock exchange versus the broader stock market. And you may have also heard people refer to a bear market versus a bull market. In fact, if you visit New York City at some point, either for pleasure or for work, and you visit the financial district, you would see statues of a bull there, kind of a famous statue. A bear market is one where you are in a prolonged period of decline in value. Usually stock values are falling 20% or more. There's negative investor sentiment. These can last weeks to years. A good example of this is, of course, the 1929 stock market crash and the ensuing Great Depression. That actually led to the creation of our agency, the Securities and Exchange Commission. But also the Great Recession of 2008, 2009. Most of us probably were not around for the stock market crash of 1929, but many of us were around for the Great Recession of 2008, 2009. That was a bit of a U-shaped depression or recession where it took us quite a while to come back up in the stock market. And we can refer to that a little bit later when we see images of how stocks have performed over the last 30 years or so. Conversely, a bull market is where there's a prolonged increase in value. Usually stocks are rising 20%. So again, kind of the opposite here. Investors are optimistic. There's a lot of confidence. And this, again, in that U-shaped recovery will typically occur after there's been a prolonged period of decline. The boom after World War II, or this kind of period of quite substantial growth in the stock market between 2010 and 2011. You'll also notice this when we do get to that chart that shows how stocks have performed. We're going to talk a little bit about asset allocation later, but wanted to just throw a couple of terms on the screen for you to highlight that asset classes have kind of grown recently. There are digital assets like crypto assets. We won't be talking about that today, but there are other things that are considered an asset class. So it's not just stocks and bonds and mutual funds, which are some of the things that we'll discuss, but it's also cash. It's also real estate, commodities and futures. Like you can actually invest in, what the price of orange juice is going to look like. So some of that is going to be treated differently in the way it's taxed and regulated by the government. So what we will talk a lot about during these 101 and 102 webinars on investing are stocks, bonds, mutual funds, and exchange traded funds. So a stock is where you actually own a share in ownership of a company, and that is representing a claim of part of its assets and earnings. So if I own stock in a company and they do well, I do well. If customers are buying their product or using their service, then we all benefit. And conversely, if no one is using that product or service anymore, stock price would fall, and that I would have to assume as an owner of that stock. A bond is basically like an IOU. One of the better examples I can give for you on this is going to be something like a US Treasury savings bond. Maybe you've seen those kind of fancy checks that they sold at the bank, 25, 30 years ago. I know my grandfather was a big fan of sharing those with me. So a bond is when you loan money to either a government or a company, and you either get interest back from that, or you will receive not only your principal, but also some interest when that bond matures at a later date. And then I'm going to lump mutual and exchange traded funds together. And the best way I can come up with to describe these is really ordering off the menu or getting the breakfast buffet at a fancy hotel. If you order off the menu, that's kind of like purchasing a single share of a stock, where you're kind of putting all of your hopes and into that investment. Maybe it's French toast that you've ordered for breakfast. Whereas a fund is going to be like ordering the buffet. You're going to be able to get French toast, eggs, bacon, hash browns, maybe some yogurt, some fruit. That is going to be a little bit of a lot of different things. So it's a pooled investment vehicle. And so both mutual and exchange traded funds can be thought of that way. And now I'm going to turn it over to Anne.
Thank you, Erin. So you've heard a lot of terms. Where do you get started? Investing has a lot of risks and rewards. So what we're going to go over next is just some of the different places that you can invest, what you're going to encounter in investing, and how to start making some of those decisions. So first off, where is it that you can go to invest money? Your employer. Your employer, generally, most employers have employer-sponsored retirement plans. This could be a 401k plan. If you work for the government, it could be a thrift savings plan. And what that allows you to do is take money out of your paycheck, put it straight into a retirement account that you can then start your saving, make it automatic so that you don't even have to think about it. That is a great place to get started. Andrea, I think you were going to talk about Illinois Secure Choice.
Yes, thank you for providing the opportunity. I would like to just comment on employer-sponsored retirement plans. While the majority of employers do offer employer-sponsored retirement plans, it's been found, at least in the state of Illinois, that only about 60% of employees have access to employer-sponsored retirement plans, which is why Illinois Secure Choice was developed to try to address the gap in access. So Illinois Secure Choice is a retirement savings program that's facilitated by the state of Illinois for employees that don't have access to an employer-sponsored retirement plan. So it allows workers to save through automatic payroll deductions into a portable Roth IRA. Employers with 5 or more employees within the state of Illinois and that has been in business for 2 or more years are mandated to offer it or some other type of employer-sponsored retirement plan so that employees can have access to the automatic contributions features of employer-sponsored retirement plans a little bit more easily. So hopefully that gives you a little bit of insight. We also shared a lot of resources on retirement and Illinois Secure Choice specifically, since I know a lot of us are in Illinois here. So let your friends know. Tell your neighbors, tell your friends. All right, I'm going to hand it back over to Ann to talk about the other methods of getting started with investing.
Thank you. Okay, so you've taken care of your employer-sponsored retirement, or Illinois Secure Choice if you don't have an employer-sponsored retirement, but you still have some money that you want to invest. What else can you do? Well, if you're still looking to save for retirement, you could potentially save money every year in an individual retirement account. That account would stay with you if you change jobs. You can adjust the rate that you're saving. There are specific federal limits that tend to change, if not every year, at least every few years. So you need to be mindful of that. But that's another place where you can save specifically for retirement, and it's money that you generally don't want to have to touch until you're ready for retirement. But there are other options as well. Investment management firms, these could be a broker-dealer, an investment advisor, a large investment bank. And through them, you can get all sorts of different types of investments. You can buy individual stocks, you can buy mutual funds, you can buy exchange-traded funds. You could also hold your retirement account there. Another option is a 529 college savings plan. And again, there are tax benefits for putting money. It needs to be used for education, so you need to look at what the restrictions on it are. But that's another way to save money and let it grow. And then it will be there when you're ready for college or your child is ready for college. There are also discount brokers, and many of them have investment apps. There are also robo-advisors. So for each of them, I would just say, look at what it is that you want to do, whether it's money that you want to invest aside from retirement, and how much you want to invest, and then you can set up an account. And with a robo-advisor, an investment app, the thing to look at is what are the fees, and is it something that you can not treat as a game that you're playing on your phone. So as I was saying, really what you need to make a decision about before choosing one of those types of firms is, what is it that you really need from a financial firm? I've heard the terms broker-dealer and investment advisor. And really the difference between when you would want to go to a broker or when you would want to go to an investment advisor depends on your personal situation, how much advice you need, and how much you want to or can afford to pay in fees and costs. So let's break them apart. For a broker-dealer, you could use it to make trades. They would occasionally give you advice with respect to those trades, but you really will be the one doing your own research, figuring out what it is you want to invest in and how much you want to invest. If you need more hand-holding, and many of us need more hand-holding, we don't have the time or the expertise behind it, you could consider an investment advisor. An investment advisor is going to give you more advice about what to invest in, when to invest in it, how much to invest in it. Each of them are paid in different ways. A broker-dealer generally will charge a fee every single time a trade is made. An investment advisor generally will charge a fee based on how much money you have invested with them. It's called an assets under management fee. And really each of these, each of the investment services have their different pros and cons. And it's really a personal decision what you want. With an investment advisor, then we can get a little more in depth. You could have an account that is completely managed where you don't make any of the investment decisions. They make the decisions for you and tell you after they've made the purchases or sales. Or you can have an investment advisor that comes to you and gets your permission before anything happens. All of that is up to you, and it's something really to think about. The questions that you should really ask are, what is it that you're looking for? How much help you want or need? How much you're willing to pay for it? And then you can go from there. Now, if you go with any type of financial professional, you need to ask about the costs. Nothing is free. Anybody who tells you that their advice and their services are free, I would ask a lot of questions before going to them. That would start my fraud radar going. And so I'd want to know a lot more information before going with somebody that says that it's free. So since these are all businesses that are designed to make money, figure out how much it's going to cost before you go and get involved. As I mentioned before, commissions and fees per transaction tend to go with broker dealers. And then fees for assets under management tend to go with investment advisors. But there could be other fees involved. You could see that there's a fee based on every time that you make a wire transfer or every time you make a deposit, or there's a fee for providing research services, whether or not you use them. So ask the question before you go in and protect yourself. Okay. And then I think I am turning it back over to Erin to talk about checking out your investment professionals.
Yes, thank you so much. So this is one of my slides that I like to talk about, and I've had to change the way I speak about this a little bit in the last year or two. So one thing that we share is that if you are going to work with an investment professional, that you check them out on investor.gov. You can see whether they are licensed and registered to sell securities in your state. You can see their employment history and any important disclosures. So you simply go to our website and type in the name of the investment advisor or firm who you want to work with, and this information will show up. Now, what I want to caution you about here is that anymore, there are so many imposter scams. And so someone might say, hey, I'm, Joe Smith from ABC Financial Firm, and they may not actually be that person. They may be impersonating a legitimate financial advisor. So when you visit this site and look up the person who you're thinking of working with, or the couple of people who you're thinking of working with, just like any project where you're going to be putting some money out there, you want to make sure that you're getting a couple of different people who you speak to. This is very important. Who you trust with your very hard-earned money is not something you want to take lightly. So put a couple of people who you've learned about, put their names in, and then make sure that you double check any of that by chatting with a person directly, using a number that you find through a trusted source, like a friend or family member or Google or something like that. But what I will say is that when you do check out an investment professional, you'll be able to see their employment history and any other important disclosures. If they have foreclosed on a home, or if they've been at 10 different jobs in the last 4 years, Is that someone you want to trust to have your money under their care? Maybe not. So think about some of those things as you do your research. The other thing that I would mention too is that there's quite a bit of research that you can do on investment products yourself. So if you have an interest in this, and if your personality is kind of a go it on your own, find out the resources that will help you. There are a lot of sources on investor.gov that you can use to research investments. So first and foremost, you're going to look at investor.gov and check out any possible professionals you may want to work with. You may visit SEC's Edgar, which is a database with a lot of information from public companies. So if you're looking to purchase an individual stock or shares of funds, you can use Edgar to do that. You can use Emma to research municipal securities and 529 plans. And we have resources on our website, investor.gov, that can share with you how to read some of these documents that are required for companies to file with our agency. So you can learn how to read a 10K, which sounds like something you might run if you're someone who does races, an 8K, insider transactions forms 3, 4, and 5. These won't just be letters and numbers to you. If you use our website to learn a little bit more about how to read those documents, that can be super helpful for you. And there are several different ways to invest. We've talked a lot about the employer-sponsored retirement plans. Individual retirement accounts, or IRAs or IRAs, are also very popular. These plans are accessible. They have tax advantages for many people. They encourage regularly investing a certain percentage or a certain dollar amount over an extended period of time. And so people can start investing for their retirement with these tools without a ton of that background knowledge on investing. So IRAs are very flexible. You can open one on your own as long as you receive a W-2 from your employer, so you've earned enough income. They work really well for that automatic investing that we're proposing that you do. They have lower contribution limits than your employer-sponsored plan, which is going to have a higher limit. Those are great if your job offers one. Especially great if your employer matches your contribution. If your employer will match 5%, you should we suggest that you also put 5% in. That way you are not leaving any money on the table. For example, if your employer will match 5% and you are only investing 3%, you are missing out on that additional 2% that they would have matched for you. And often, because it's taken out of your paycheck before it hits your checking account, before you can use it with that debit card, sometimes the impact is not as great as you may fear. But both of these accounts are just the types of accounts that hold these investments specifically set aside for a time when you will no longer be working your regular job. With the IRA, again, you have to have earned income, but you can start contributing at any age as long as you are 16 or older. Your contribution limits will vary by year and age. So for example, if you are 16, or if you are a non-working spouse of someone who is earning income, you can contribute $7,500 this year in 2026. If you are older than 50 and even older than 60, you can contribute a bit more in kind of a catch-up contribution type of thing. So there are several different types of IRAs. A traditional, where the money goes in before taxes are taken out, which means it lowers your taxable income for this year, but then you will pay taxes on it when you start to withdraw that money in retirement. A Roth IRA is the reverse. you pay taxes on that money before it goes into the IRA. And then when you withdraw that money later in life, when you're in retirement, you will have already paid taxes. There are also SEP, SEP, simple IRAs. Those are for people who either work at a very small organization, or they may be people who work for themselves, have their own business. Andrea, I'm going to pop it over to you for the next slide.
Thank you so much, Erin. So I really want to emphasize on what Erin talked about regarding the employer contributions or employer match. So vesting is something that you'll want to pay attention to when taking advantage of that employer-sponsored retirement plan match, where the employer offers to match your retirement contributions up to a certain amount. In order to keep those contributions, you'll need to meet certain criteria that the employer is the one that defines for being vested. So if you leave that employer, if you aren't vested, any of the contributions that they made, they're going to keep. So it's important when you're using employer match as part of your overall wealth building strategy that you know how long you need to work with that employer to keep those contributions. So I'm just going to talk as quickly as I can through this example of what it means to maximize your employer match. I think that Erin already did a really good job of providing an example, but here's one with a visual. So let's say your employer offers a match up to 50% of your contributions, up to 6% of your salary towards a 401k. There are other numbers and letters associated with employer-sponsored programs, but we're going to say this one's a 401k. You have to work there at least 5 years to be vested so you can keep the employer contributions as well as your own contributions if you leave the company. So if you make $60,000 a year and contribute 3% of your salary, that would mean $1,800 that you contribute and your employer contributes $900 for a total contribution of $2,700. Assuming a 7% return over 30 years, you'd have $256,000 after 30 years. However, if you want to max out your contribution at 6% of your salary, that would be a total of $5,400 in annual contributions between you and your employer. And again, assuming a 7% return, you'd have over $510,000 in your retirement account after 30 years. So you definitely don't want to throw away that extra $1,800 benefit from your employer in this situation. And that additional contribution could nearly double your retirement fund's growth over a 30-year period. But that's considering exponential growth. We've had some questions in the chat I think we're going to answer later, but I have a tool that I might share in our follow-up email that might help you visualize what exponential growth looks like for your individual situations. And then I'm going to hand it back over to Anne to talk about mutual funds and ETFs.
Thank you, Andrea. Okay, so you have maximized your retirement savings. You've taken care of all of that. You've checked out your investment professional. Now what? Where do you start when you're ready to invest, but you don't know what types of investments you want to choose? So one thing that you could pick would be a mutual fund or an ETF. So let's talk a little bit about what's the same and what's different between them. So they both are a pool of money. So essentially your money with other people's money is all being put together in one big pool. And then an investment company pulls all of that together and invests it in a bundle of stocks, bonds, or other securities, or some combination of all of them. Essentially, what it is automatic diversification, depending on the type of investment you're doing. It has a professional manager that you're not paying for separately to do that for you. Instead, they do it for everybody in the group, in the pool. They're generally pretty affordable. The amount that you can invest is not limited to only very, very high net worth investors or very high investment amounts. And the risks are typically the same as the underlying securities, but remember, you're investing in a bundle of securities instead of just one single stock. And that one single stock, if that one single stock goes bankrupt, then there are still other securities in the bundle. Those are the similarities. When you start trying to decide between a mutual fund or an exchange traded fund, there are some difference between them. Mutual funds are priced at the end of the day after all of the returns for all of the investments in the mutual fund have come in. So after the market closes, they're priced. For an exchange traded fund, it's traded on the exchange and it is priced throughout the day. They also disclose their holdings at different times. An exchange traded fund, you pretty much can look up at any point in time what types of individual companies and individual company securities are in the exchange traded fund or ETF. For mutual fund, you find out at the end of a quarter or other periods when they disclose everything. See, okay, we're running a little behind, so I'm going to move on really quickly. What is the difference then between an ETF and an index fund? An index fund could be either an ETF or a mutual fund, but it's one way to achieve automatic diversification. They're not actively managed, so the fees tend to be quite low because they just invest in the entire index. So say you have an S&P 500 fund. The S&P 500, we'll show a graphic in a moment, but the S&P 500 in short is the biggest 500 companies in the United States. And that is the benchmark by which a lot of investments performance is really judged. So you buy an S&P 500 fund, you're basically getting diversification, a little bit of each of those companies with low fees and automatic diversification. You don't have to worry about individual stock picking. Okay. There are other indexes as well that you could invest in. You can have micro cap funds or more like a mid cap fund is a better example. And then some ETFs are index funds. They are exchange traded funds that invest along the lines of an index. Others can be more specified into a particular area. On to the next slide. So we've mentioned diversification a number of times just to make sure that everyone understands what that is. It is a way to lower the risk of your investments. So instead of investing in one company, your investments are spread amongst a bunch of different companies or a bunch of different sectors or a bunch of even different asset classes. So if one company or a particular segment of the industry loses value on a particular day, your other investments may limit the losses or possibly even post gains and allow your overall portfolio to grow. We've got a graphic that shows this beautifully. This is one of my favorite graphs that we ever present about because this is a day in the life of the S&P 500. So say you had your entire net worth invested in a single stock. And I'm just going to pick one. We'll pick Procter & Gamble, which is up in the top right corner. It was down 1.57% that day. You'd probably be upset if that was everything, because you'd take a look at your brokerage account on an app and see it was down. Now, say you invested in the consumer defensive sector. Mostly those are in the red. That means they're mostly all down. So then again, you'd be pretty upset if that was where everything you had was invested. All your eggs were in that basket. If you invested in the S&P 500, however, there's quite a bit of green in this particular day. So there are a number of different stocks that are up. So you'd actually potentially post gains or at least break even if you were invested across all of these different companies. And one thing I should note on this particular slide, you can see that the different squares are different sizes. Right now, the S&P 500 is very weighted in a smaller number of companies. So the bigger the box, the greater portion of the S&P 500 it really is making up right now, and the more influence it has on the S&P 500's overall performance. But again, this is a really good way to see if you put your eggs all in one single basket, you might have a pretty bad day. If you invest across all the different possible baskets, then you would even break even or be up and be having a much better day. Okay, I'll turn it back to Andrea to close us out.
Thank you so much. So we have 2 polls that we're going to launch just to kind of help you think about investing as a practice. So let's say in the 1990s, as the internet began to take off, you had the opportunity to start investing. We're pretending, right? I'm guessing a lot of you weren't 16 yet in the 90s. But if you were, which company would you have invested in? Would you have invested in a well-known big box retailer with a strong national brand, loyal local customers, and a widely used mail order catalog, or a small Seattle startup focused on selling books online? Right? Those are very different things to consider. So in the second poll, let's say it's 2002 and you were told that cell phone technology would drive stock growth over the next 20 years. Which company would you have invested in? The maker of the most popular cell phone in 2002? A company producing a cell phone that could send and receive emails? Or a company known for personal computers and portable MP3 players? I'm seeing the poll responses and they're all kind of shuffling around as I'm talking through these. About 60% of people have participated. I'm going to end the poll and share the results real quick. You can see it's like 45-55 on that first poll. So 45% would have invested in a well-known big box retailer, and 55% would have invested in the small Seattle startup. But hindsight's 2020, and there was no way to know that that small Seattle startup would have turned up around to be what we know today, right? We're not saying names, but you know what we're talking about. In 2002, that's kind of all over the place as well, that situation. So the maker of the most popular cell phone, about 18% of you said that that's where you would put your money. 45% of you said you would have put your money in a company producing a cell phone that could send and receive email. And 36% of you said a company known for personal computers and portable MP3 players. But if you didn't have the knowledge of the past 20 years, would you have made those choices? So I'm going to stop sharing and kind of summarize what we want you to take away from those 2 polls. Predicting which stocks and which companies will be really popular and rise in value is extremely difficult because industries evolve very unpredictably. Technologies, consumer preferences, and competitive landscapes shift very, very quickly. So a company that looks dominant today can lose ground unexpectedly, while a small, unknown competitor can suddenly become the next big success. Another thing to consider is that past performance does not guarantee future performance. So the companies in the 90s and early 2000s that were most prominent were not the ones that ultimately drove long-term stock growth. So even experts often guess incorrectly. Information is often uncertain and incomplete, so investors never have perfect information. Products that seem promising today may fail, and companies with early struggles may end up thriving. So early indicators often give conflicting signals when it comes to investing. The other thing is, like I said, markets evolve kind of unpredictably, industries do, markets react unpredictably too. So stock prices depend not only on company performance, but also on investor sentiment, global events, and broader economic conditions. So none of which can be forecasted with certainty. And even broad trends don't really reveal very specific winners. Knowing which industry will grow, like the internet or mobile phones, still doesn't tell you which company within that industry will succeed. Like Anne was talking about with the FinViz graphic from Monday that we were showing, you kind of have all these different players within an industry that had a bad day, except there were a couple that were green. So it wasn't obvious who the winner would have been if you were picking the day before or last week in that particular area. So just to summarize, it's important that you have a financial plan in place first. You want to pay down any high interest debt that you have before you start investing. You also want to have an emergency fund in place in case something happens. It doesn't have to be expansive, but you want to make progress towards that emergency fund goal. You also want to inventory tools for long-term investing and maybe even protecting your assets. You might have assets that you need insurance for, and so you might have to divide and conquer, kind of using budgeting as your weapon of choice. And then you also want to compare costs and diversify your portfolio to limit your risks. And again, we didn't cover everything that there is to know about investing. So you can use investor.gov. We have other recorded webinars, and we have an upcoming webinar where we're going to focus on the risks and rewards of investing on the 25th in 2 weeks. We also have several episodes related to investing in technology and budgeting and all kinds of stuff on the Making Sense of Money podcast, including student loans, which I talked about earlier. And you can also use simulations like the stock market game or Market Watch's virtual stock exchange to get an idea of what it is to invest before actually putting your hard-earned money into the market. So like I said, Investing 102 is in 2 weeks on February 25th at noon. We have a post-webinar survey that will help us increase our improve our future webinars as well. You can watch previous webinars on YouTube. Once the captions are edited for this particular one, we will get that up on YouTube, and we will also send it to all of the people that registered via email, along with all of the resources that Emmy shared in the chat, and then some bonus ones, because I think that there are some other valuable tools that we can send you for some of the questions that we got. I want to thank all of our collaborators on the Get Savvy webinar series. We are going to wrap things up for now, but if you have questions, you can always email studentmoney@uillinois.edu, and we will do our best to give you an educational response. We can't provide advice, but we can give you education. Thank you for joining us today.